Welcome back to the Florida Veterans Real Estate Podcast. I'm Darian's avatar, and this is episode 11. We've covered your entitlement, the COE, and the stepping stone strategy. Now we dive into the most unique and often misunderstood pillar of the VA loan underwriting process, residual income. Every other loan, FHA, conventional, USDA, they all focus on your debt-to-income DTI ratio. They want to know what percentage of your gross income goes toward debt. And yes, the VA looks at DTI too, with a preferred cap of 41%. But here is the critical tactical truth. For the VA, residual income is the primary indicator of your financial stability. The VA, quite literally, cares more about the raw dollars left in your pocket than the percentage of your income you spend. Our mission today? To explain what residual income is, how to calculate it, and why it is the key to unlocking your loan approval, especially when you are pursuing a high-leverage move like a new construction or a multi-unit property. Now here's the VA's mindset. The Department of Veterans Affairs is not a bank. It's a guarantor with a mission. That mission is to ensure you and your family can survive the monthly grind after the mortgage is paid. This is a stability-focused metric designed to protect veterans from foreclosure. It's the difference between being able to afford a payment and being able to afford a life. This episode will break down the following phases. Phase 1, DTI versus residual income, defining the difference and why the VA prioritizes cash floor over debt ceiling. Phase 2, the calculation drill. A step-by-step guide to calculating your residual income, including the critical subtractions the VA makes. Phase 3, the regional requirements, Florida focus. Understanding the VA's geographical and family size charts and how they impact your target number. Phase 4, compensating factors and tactical overrides. How a high residual income can override a high DTI and serve as your ultimate compensating factor for approval. This knowledge is your final layer of armor in the underwriting process. Let's engage Phase 1. To understand the power of residual income, we must first clearly define the difference between it and the traditional debt-to-income ratio. Think of them as two different kinds of intelligence reports on your finances. The DTI report, the percentage analysis, debt to income, DTI ratio, is the standard underwriting metric for the entire lending industry. Definition: DTI measures your total monthly debt payments, credit cards, car payments, student loans, and your new mortgage PITI as a percentage of your gross monthly income, your pay before taxes. The VA guideline. The VA prefers a DTI of 41% or lower. The flaw: the DTI only tells a partial story. For example, two veterans may both have a 45% DTI. Veteran A makes $4,000 gross and has $1,800 in debt. Veteran B makes $10,000 gross and has $4,500 in debt. They both have a high DTI, but Veteran B has nearly 3 times the amount of cash left over. The DTI does not account for the absolute dollar amount necessary for basic survival. This is why the VA went beyond it. Let's look at the residual income report, the cash floor analysis. Residual income is the VA's unique, mandatory financial safety net. It is a true measure of your household's financial breathing room. Residual income is the amount of net income you have left over each month after you have paid all of your major, fixed monthly obligations. This remaining cash is what you use for food, gas, clothing, childcare, and unexpected daily expenses. In the official VA underwriting manual, the VA states that DTI is a guide, but residual income is the primary underwriting factor. This means residual income carries more weight in the final approval decision. The VA learned through decades of data that borrowers who meet the minimum residual income thresholds are statistically less likely to default on their loan, even if they have a higher DTI ratio. The VA prioritizes the ability to buy groceries over the ratio of debt. This focus on absolute cash on hand is what makes the VA loan fundamentally safer for the borrower than any other loan product. The calculation shift. gross versus net. A major source of confusion is the income base used for the calculation. DTI uses gross income, your total pay before taxes and deductions. Residual income is a net calculation. It starts with your gross income and subtracts the estimated cost of federal, state, and local taxes, including FICA. This is the first critical step that moves the VA analysis closer to your actual take-home pay. The key takeaway for this phase is simple. The VA is testing your liquidity for daily life. Your DTI may look intimidating, but if your residual income is high, your underwriter has a powerful compensating factor to approve your loan. Let's get tactical and execute the residual income calculation. This is a step-by-step drill to find your financial breathing room. Step 1. Determine your effective gross monthly income. This is your reliable, stable income before any taxes or deductions. Crucial VA allowances. Do not forget to include tax-free military pay like basic allowance for housing, BAH, and basic allowance for subsistence, BAS. Since these are tax-free, the lender will often gross up these amounts by 15 to 25% to account for their added value compared to taxable income, giving you a massive advantage. Step 2. Subtract monthly federal, state, and local taxes. The income tax deduction. This is the critical first subtraction that separates the residual income calculation from the DTI. You need to estimate or use your current tax rate to determine the average monthly tax burden. A specialist VA lender will have charts for this or use your W-2 history. Why does this matter? This adjusts your starting point from your paycheck stub's gross amount to something much closer to your actual monthly take-home. Step 3. Subtract recurring monthly debts. These are all the debts that factor into your DTI calculation: minimum monthly credit card payments, car loan payments, student loan payments, child support or alimony payments, other installment loans. Step 4. Subtract the new housing expense, PITI. This is the projected monthly payment for the home you are buying, principal and interest, P&I, on the mortgage. Taxes, property taxes divided by 12. Insurance, homeowner's insurance divided by 12. Here's something to think about. Utilities are factored differently and often included in the PITI calculation for multifamily homes in the VA residual income analysis. But for a single-family home, we primarily focus on PITI. The result: your calculated residual income. What remains after step 4 is your residual income, the cash the VA believes you have left to manage your life. Tactical note: income exclusions and compensating factors. Excluded income. Do not include temporary or unstable income like one-time bonuses, unemployment compensation, unless seasonal, or temporary retirement drawdowns. Tax-free income as an override. If your DTI is over 41% only because a large portion of your income is tax-free, like disability compensation or a high BAH, the VA underwriter can easily approve the loan because your effective take-home pay is significantly higher than the DTI ratio suggests. This is a direct example of residual income reigning supreme. Mastering this calculation allows you to enter the negotiation and underwriting process with confidence, knowing exactly where your financial safety margin stands. Unlike the DTI, which is a single percentage goal for the entire country, the VA's residual income requirement is tailored to the true cost of living. This is where the VA's analysis becomes hyper-specific and regionally aware. Here's a fun fact. The VA divides the continental United States into 4 regions, acknowledging that a residual income of $1,000 left over in New York City does not go as far as $1,000 left over in rural Oklahoma. There are 4 regions the VA recognizes: 1, Northeast 2, Midwest 3, South, where Florida is located, 4, West. Since we are focused on the Florida Veterans Real Estate Podcast, your target is the South region on the VA residual income chart. Another fun fact: family size matters. The minimum residual income required from you changes based on 2 factors. 1, Your family size, household members. This is counted broadly and includes the veteran, a spouse, even if not on the loan, children, minor and adult dependents, any other individual for whom the veteran is responsible for financial support. Let's hit on loan requirements for a second. Requirements are slightly lower for loans under $80,000, but nearly all new construction and Florida home purchases will fall into the $80,000 and above category. For an example, let's break down the precise targets for the South region, which is our area of operation. Note, these figures are subject to annual change and are for demonstration only. Always confirm the current figures with your VA lender. I highly recommend that you memorize the minimum cash flow requirements that pertain to you. A family size of 1 requires a minimum residual income of approximately $441 per month. A family size of 2 requires a minimum residual income of approximately $738 per month. A family size of 3 requires a minimum residual income of approximately $889 per month. A family size of 4 requires a minimum residual income of approximately $1,003 per month. A family size of 5 requires a minimum residual income of approximately $1,039 per month. For families larger than 5, you must add approximately $80 for each additional member. So let's take a scenario here. If you are a veteran buying a home in Jacksonville with a spouse and 2 children, family size 4, you must demonstrate to the underwriter that you will have at least $1,003 left over every month after all your major debts and your new mortgage payment are satisfied. This is what we call, quote, the floor, end quote. Here is an example of below the floor. If your calculated residual income is $950, you are below the floor. Your application will be flagged, and you will need to rely heavily on compensating factors covered in the next phase. Here is an example of above the floor. If your calculated residual income is $1,500, you are safely above the floor, and your ability to be approved is significantly enhanced, even if your DTI is high. This phase is about knowing your target. You must know your minimum residual income requirement before you even start shopping for homes. It is the tactical boundary for your purchasing power. Next, we will discuss compensating factors and tactical overrides. This is the crucial phase where we transition from following the rules to mastering them. The VA's underwriting is not a rigid yes or no system. It is a system built on compensating factors, and high residual income is the most powerful one. The 41% DTI override, the 20% rule. The standard VA DTI is 41%. If your DTI is above 41%, say 45 or even 50%, your loan is flagged for manual close scrutiny. However, there is a clear written path to approval. The 20% rule. Let's break the 20% rule down. If your DTI ratio exceeds 41%, your loan can still be approved automatically if your calculated residual income exceeds the VA's minimum requirement for your region and family size by at least 20%. Example in Florida, South region, family of 4. Minimum required residual income, $1,003. Multiply that by 20% and you get $1,203.60. Any residual income at or above that gets you approved. A little confusing, I know. Don't be afraid to back up and listen to this part again. It will be well worth the extra time, I promise. In layman's terms, if your DTI is 45%, but your residual income is $1,204, your high DTI is effectively neutralized. The underwriter sees that even with higher debt obligations, you still have more than the required buffer for monthly life expenses. This rule is the veteran's ACE card. It allows you to take on slightly more debt to secure a better home or execute a high-leverage strategy like the duplex house hack, which may temporarily elevate your DTI. Conversely, if you slightly miss the residual income target, you can use other factors to compensate. These are not as powerful as the 20% override, but they add weight to your application. 1. Significant cash reserves, having several months, 3 to 6 months is preferred, of your mortgage payments sitting in the bank provides a safety buffer. The underwriter sees this and knows you can handle a short-term crisis. 2. Excellent credit score. A score of 720 or better shows a pattern of financial responsibility that can outweigh a slightly low residual income. 3. Low payment shock. If your new mortgage payment is only slightly higher than your current verifiable rent payment, the underwriter sees a low payment shock and is more confident in your ability to handle the new cost. 4. Sizable down payment. Voluntary. While you have the zero down benefit, voluntarily putting down 5 or 10% can significantly reduce your loan amount, boost your equity, and act as a strong compensating factor if your residual income is marginal. The tactical lesson here is to analyze your finances through the VA's lens. If you know your residual income is high, you can push the DTI boundary and go after the house you need to build your wealth. If your residual income is marginal, you focus on boosting your reserves and credit score to strengthen the application. Residual income is not just a calculation, it's a strategic checkpoint. Knowing this number empowers you to make smarter choices about which properties you target and how you structure your finances. Strategic focus, new construction, and the residual income buffer. When veterans pursue new construction homes in Florida, our podcast goal, they are often buying the most expensive home they can afford, which naturally pushes the boundaries of DTI. The new construction advantage. A high residual income provides the essential buffer for new construction. If you have the cash floor, you have the financial stamina for unexpected overruns, delayed closing costs, or a period of slightly higher than expected utility bills in the first year. The tax-free income lever. We have to re-emphasize the power of tax-free income, particularly for active duty members. BAH, BAS, and disability pay are not burdened by federal taxes, yet the VA underwriter uses the equivalent grossed up value in the DTI calculation while retaining the benefit of the tax-free status in the residual income analysis. This is a massive, built-in advantage that creates a naturally higher residual income for military families compared to their civilian counterparts with the same gross pay. You must ensure your VA lender is correctly applying the gross up to maximize this lever. Implementation, the mortgage specialist advantage. You cannot execute this strategy with a generic bank loan officer. You need a VA mortgage specialist who is fluent in the VA's underwriting manual. Why a specialist is crucial. A general lender may see a DTI over 41% and immediately deny your application because they do not understand the 20% residual income override rule. A VA specialist knows the charts, knows the exact calculation, and knows how to structure your file to highlight your high residual income as the key compensating factor. They are your translator and advocate in the underwriting process. Pre-approval power. Your pre-approval should not just be based on DTI. Demand that your pre-approval letter specifically addresses your residual income level and confirms that you meet or exceed the South Region minimum for your family size. This gives your real estate agent the confidence to make competitive offers. In the end, residual income is the VA's way of ensuring the mission, your family's financial stability, is never compromised by the vehicle, the mortgage. It's a focus on sustainability over initial qualification. Understand it, master the calculation, and use it to your advantage. Mission complete on residual income. You now understand why the VA loan is fundamentally safer for you, the veteran, than any other loan product on the market. Here's the after-action report, the final checklist. Residual reigns supreme. DTI is secondary. The ultimate approval power lies in your residual income, the cash left over after all major bills, including taxes, are paid. Know your target. You are in the South Region. Identify your family size and confirm the exact minimum dollar amount you need to meet from the VA charts with your lender. Master the calculation. Remember to start with gross income, subtract taxes first, and ensure all your tax-free military allowances, BH, BS, disability are correctly grossed up to maximize your effective income. The override. If your DTI is over 41%, calculate the 20% residual income buffer to ensure you still qualify automatically. A high residual income is your ultimate compensating factor. Use a specialist. Only work with a VA lender who is expert in the residual income calculation and the compensating factor rules. This number, your residual income, is the financial safety margin that ensures you can handle your new Florida home without sacrificing your family's quality of life. Use it to push the limits of your purchasing power responsibly and build the generational wealth you've earned. Mission complete on residual income. You now understand why the VA loan is fundamentally safer for you, the veteran, than any other loan product on the market. Here's the after-action report, the final checklist. Residual reigns supreme. DTI is secondary. The ultimate approval power lies in your residual income, the cash left over after all major bills, including taxes, are paid. Know your target. You are in the South region. Identify your family size and confirm the exact minimum dollar amount you need to meet from the VA charts with your lender. Master the calculation. Remember to start with gross income, subtract taxes first, and ensure all your tax-free military allowances, BAH, BAS, disability, are correctly grossed up to maximize your effective income. The override. If your DTI is over 41%, calculate the 20% residual income buffer to ensure you still qualify automatically. A high residual income is your ultimate compensating factor. Use a specialist. Only work with a VA lender who is expert in the residual income calculation and the compensating factor rules. This number, your residual income, is the financial safety margin that ensures you can handle your new Florida home without sacrificing your family's quality of life. Use it to push the limits of your purchasing power responsibly and build the generational wealth you've earned. If this episode helped you get a little clearer, follow the show and share it with another veteran who needs it. And remember, everything you want is on the other side of fear.